Hey folks, welcome back to the channel. If there is a rate cut this coming week, then that will apparently be good for the Canadian banking sector. However, even if we do get a rate cut, is it a good idea to buy bank stocks right now? Well, I think the answer is no, because from a fundamental standpoint, the valuations are not cheap for Canadian banks right now. And from a technical standpoint, there's also no clear indication that the financial sector has bottomed. Let's look at fundamentals first. We just got news this past week that not only did we miss on the most recent GDP reading for the first quarter, but the previous quarter in Q4 of last year, 2023, was revised down by quite a lot. It was initially reported as 1%, that's the annualized growth rate, but we've now learned that the fourth quarter GDP has been revised down to 0.1%. So basically, the economy did not grow at all, which is surprising considering how much the population grew in that quarter. In my last video, I talked about how the Bank of Canada probably won't raise rates unless we have really bad economic news, and I would consider this to be pretty bad. Not only did the previous quarter grow by 1/10 of what was originally reported, but also the latest quarter that we had in Q1 of this year, the Bank of Canada was expecting 2.8%, but instead we got 1.7%. So that's more than a whole percentage point lower than what they thought. So because of this new data, I'm now kind of 50-50 because the US still isn't going to cut rates in the short term. So the Bank of Canada still has some time to think about their next interest rate decision. And with immigration at full throttle, the last thing they want to do is to push housing prices or food prices or encourage other types of inflation. So we'll have to see. But in terms of the Canadian banks, it's important to note that bank stocks are kind of like a proxy for economic growth because banks make more money if the economy does better. And because the economic situation is not looking too good, based on the fact that the GDP numbers are coming in lower than expected and previous data has been revised down, there's probably going to be more pain to come in the economy. And that's probably why you're seeing a lot of volatility. Like the Bank of Montreal, one of the large five banks, dropped 8.6% on a single day, which is very rare to see for a Canadian bank. Also, last month, TD fell 5.8% in a single day. So these types of numbers, and although this is more based on news, drug trafficking allegations, it's an indication that traders and investors are really not sure about the financial sector. And when we look at the valuations for Canadian banks, they're not even that cheap. For TD, for example, over the last 14 years, the PE ratio for the most part stayed between 8 and 10 times. Recently, it went up as high as 13, but now it's coming back down. So the price to earnings ratio is not cheap compared to historical standards. So when we have compression, it likely means the ratio will continue to go lower. So unless I see it either change direction or get below 10, it doesn't make it a very attractive stock to buy right now. Again, this is fundamentals. We'll look at technicals as well in a bit. And here's a look at the largest bank in Canada, Royal Bank. The PE ratio is at a whopping 13.66, which is the highest it has been over the last 14 years. So this stock is objectively expensive right now if you buy it, comparing its current valuation to the last 14 years. And another way you can tell it's expensive is because if you look at the earnings per share here, which is how much profit the company earned each quarter per share, it is down from 2 years ago. It's slowly creeping up from the bottom last year, but at only 7.93, it's nowhere near the top of its peak earnings back in 2022. However, even though the company is making less money, for some reason, this top chart here is the stock price. It's near its all-time high. So this means a lot of people are pricing in rate cuts in Canada and the US before they even happen. Now, if you have a 5-year or longer time horizon, buying the stock now probably isn't a bad idea. You might get a modest return on your investment as this earnings per share is continuing to show steady growth over the long run, which will translate into higher stock prices eventually. But short term, I think this is kind of expensive and will probably get a better opportunity, meaning the price will come down before it goes up again. And we'll usually see that play out in the business cycle where the economy gets worse first, which it looks like it is starting to. The recession will probably hit later this year, as I've elaborated in previous videos. And then we have rate cuts, and that's when you'll typically see the stock, especially the economically sensitive ones like banking stocks, have a correction as well. and we may have already seen the start of that. If we look at ZEB, which is an ETF that tracks the Canadian banks, it's an equal weighted index consisting of the 6 largest banks in the country. We can see there's been a lot of volatility over the last week, and although it is showing support over here, it might come down and touch this one more time. 1, 2, 3. It's not showing any signs of strength yet. You can see it's made a lower high when it came up before, and now it's coming back down. Bounced off here, we'll see where it goes. But if it continues to go in this pattern, then it'll pretty much form this triangle. And typically that would resolve to the downside. And if I zoom out to the weekly chart so that each bar represents a week, we can see that it met pretty heavy resistance up here. And although the price is above the blue line right now, which is the 21 exponential moving average, it hasn't really taken off yet. It really needs to get out of this triangle and go higher than this black line first, and then eventually cross above this purple line for there to be sustained lift. And if we take a look at TD stock, which I have been talking about for the last couple of years, in fact, I drew this triangle like a year and a half ago, mentioning before the stock price reaches the point of the triangle, it will most likely either resolve up or down. So it looked like it broke out of the triangle first late last year, but instead of bouncing off the top of the triangle and going higher, it actually came back down. And again, we're on the weekly chart here. So when it came down, it broke through all of the moving averages, the 9, which is the green one, the 21, which is blue, and then the red one is the 50. And you can see it's been below the red line ever since. It's tried a few times to come back up, but every time it just gets rejected from the exponential moving averages, especially this red one, and just continues to move down. In fact, a couple of months ago, during a really red week, it fell so hard it actually broke the bottom support line, which is here, which has been acting as support for a really long time. So if I were to redraw this triangle, it's now become more of a wedge, because every time it comes down to this line, you see how it's making a new low? And that parallels to the upside, where every time it tries to go up, now I have to extend this out here, it also makes a new low. These 2 points are about even, but the next one was lower, and we're going to see what happens over here. But because all of the exponential moving averages are pointing downwards, and the stock price is also below all the moving averages, this is not a very good time to get into the stock, because if the stock ends up breaking this bottom line here, it could fall to as low as 65, because that's where the next strong level of support is. So from a technical point, TD is not a buy right now. In fact, if you use tradingview.com and you look up a stock, on the right-hand column, it gives you a summary indication on the technicals and also the analyst's ratings. So for Canadian banks, you typically have a buy analyst rating. That's going to be the case no matter if you're in a bull market or down market. But if we take a look at the technicals, it is a sell right now, meaning based on the historical chart pattern, it's most likely going to go down before it goes back up. And if I click on more technicals, it actually gives you a more detailed look. So this is a daily summary. If we look at the moving averages, which is what I use, you can see it's a strong sell. There's almost no indications of buy, just one, but there are 13 sell signals right now. Switching over to the weekly, and it is a strong sell as well. By going from daily to weekly, we've basically extended the window of time to see where the stock was. And it looks like on the short to medium term scale, it's probably not a good idea to buy TD stock right now, or really any of the other Canadian banks. We've looked at Royal Bank, TD, let's look at BMO. I haven't looked at this stock too much, but this could easily be a head and shoulders pattern, especially since it broke down below the 50 moving average. I wouldn't be surprised if over the next couple of weeks we have the green 9 EMA cross below the blue 21, and both of them will eventually cross below the red line, kind of like what happened over here. And as you can see, that led to some pretty dramatic selling over the next few months. Obviously, it's not a guarantee, but that's how typically head and shoulder patterns play out. And if we take a look at the valuations for BMO, we can see it's pretty much the same thing. PE ratio near all-time highs, so fairly expensive. The company is earning $6 per share, which is pretty much what it was earning back in 2013. So that's more than 10 years ago. 10 years ago, the price was at around $45, $50. So probably not the best time to buy. Those are just some of my thoughts. I think long-term Canadian banks are still going to be really good investments because we only have a handful of them in Canada. And as the population grows, these banks should be able to turn those newcomers into new clients. But just in the short term, I don't think this is the best sector to be putting money in right now. Anyway, thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.